Welcome back. Deutsche Bank is out with its 2026 market outlook, seeing the S&P 500 headed to 7,500 price target by year end. Betting on the U.S. to slightly outperform international stocks and the dollar to rise again. Joining us now is Deutsche Bank Wealth Management CIO Deepak Puri, right here on set. Welcome.
Thank you.
So, dollar had a big year to the downside this year. You think it comes back next year? Why?
It's not necessarily a very strong dollar call, but we do think there's going to be a level of stabilization. You're not going to see this weakness that we saw, especially in the first half of this year. If you look, the dollar started to stabilize in the second half. Since this Mar-a-Lago Accord related, concerns that people had. I mean, there was a concern that the incoming administration really wanted a weak dollar just to make sure that the trade deficits gets rectified and our exports become more competitive. I think now the narrative has changed, especially with the Fed now saying that we're not going to be cutting as many cuts going into 2026 as what the street was initially expecting. So I think when you look at the strength of the economy, which tends to be a good precursor to the underlying currency strength, when you look at the fact that the equity markets are generating double-digit returns again this year, that should attract a lot of fund flows. When you look at all these things together, it's hard to make the narrative that the dollar is going to decline as much as we saw this year. And if you were to zoom out a bit, yes, dollar had a pretty weak 2025, but we're still up 7%, since 2021, and on an annualized basis around 2%. So I'm not too, our outlook is that against some emerging market currencies, you might see a little bit of a dollar weakness, but euro dollar at 115 and dollar yen at 145 is our 12-month outlook.
On a day where we're getting reports that there could be more seizures of more Venezuelan tankers, how does geopolitics factor into this market here? Or is it calming down looking to 2026?
Actually, obviously at any given time, geopolitics can flare up and play a role, especially when you're talking about oil, which is a political commodity. So you want to keep an eye on it, and it's one of our themes. But having said that, I think we are entering 2026 at probably a better geopolitically than maybe 2025, where we had a new administration coming in and a lot of elections, from the rest of the world. That there was this Middle Eastern crisis, which seems, at least for the time being in the rear view. So I think the geopolitics may end up being a little bit more subdued in 2026 than it was in 2025.
Speaking of politics, maybe a little bit of a wild card. Some of your positivity around the dollar and maybe the overall U.S. market has to do, it sounds like, with the Trump administration and GOP policies. But right about summer, we're going to start to get some post-primary midterm polling. Will that affect the market sentiment?
John, I mean, the midterm election year tends to have a very sort of peculiar market narrative. The first quarter and the fourth quarter of the year tends to be really positive, but there is a definite summer lull. So second and third quarter, right before the elections, market tends to be sideways and slightly negative. And I would not be surprised if that's the sort of course the market takes. Then you tend to get a relief rally post the elections. What could be a little bit more decisive this time around is the fact that we are having, the one big beautiful bill, a lot of these tax incentives that are going to hit. You're looking at a 20% year-over-year increase in tax refunds in the first half of the year. That could spur some additional, spending and animal spirits in the market.
Are the stakes higher for that middle period and for the market overall, given how muscular the executive has been this time around, and given the fact that the GOP has had both houses of Congress and the presidency in order to get these policies through?
Absolutely. I mean, the bar is pretty high, and the market needs to see a lot more than what they have seen so far from the GOP, from the administration, especially, if you think about this K-shaped economy narrative that's been going on, right? So for the bottom half of the households, what is being done? And I think as we get closer to the midterm, I think there's going to be more of that effort to really make sure that there is this consumer spending, that's building up. Not just the GDP is a capex story, which has been the case, right? If you look at why the GDP has done so well, and again, going back to our outlook, that is primarily being driven by the non-resi, fixed asset investment / AI data centers being built and contributing a lot. You really need to see the biggest component of the GDP, which is the consumer, needs to start firing, if not on all cylinders, at least on most cylinders.
Okay. Deepak Puri, thank you for joining us.
Thank you so much.